Hello, folks. Steve Lentz here with Discover Options here at Option View Systems. Welcome to this presentation of three different S&P 500 market timing reports for advanced options traders. These will be for Friday on April 20th, getting ready for Monday's open on the 23rd. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started, please subscribe if you could. That way you'll get alerted when we come out with new videos. And also we have a free ebook for you, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Just click the link, give us your data, we'll get that right out to you. All three reports relate to the current market condition, and we're defining our current market condition in three different dimensions: price action, trend, and the stochastic situation. In terms of price action, we have two consecutive downswing bars, Thursdays and Fridays. This occurred above the 25-day simple moving average. Now we're at a very strange point here with regards to the moving averages, because Friday's close was just barely underneath the 50-day simple moving average, which is what we usually use. And if I were to change this and say that these occurred, the stochastics and the price action occurred below the 50, well, we would only have 38 occurrences. And that would change the results compared to what we have now using the 25-day that we're above it. That's 162 occurrences of this situation. So we're going to use the 25-day, say that we're above it, and then look at the stochastic where we're between 60 and 100 and we're trending downward. All right, so we're coming down in a downtrend above that, kind of in a high overbought area, kind of trending downward there. So we take this is our current market condition. Again, it's occurred roughly 162 times in the past. Let's go to the first market report, which is for the Condor and Butterfly option traders. And, we've had roughly 4,588 occurrences of the S&P 500 having a daily close. Now, of those 4,588 daily closes, 64.6% of those have been favorable bars for selling option premium in a neutral, delta neutral sense via condors and butterflies, where the actual subsequent 21 bar movement was less than what the option prices were implying. And we measure that through the skew adjusted VIX. All right, so you could flip a coin and there's a 64.6% chance you're going to land on a bar going back to Jan of 2000, which ended up being favorable for selling premium through condors and butterflies. Now, during that time also, we've had this current market condition occur 162 times. Of those 162, 69.1% of the bars have been similarly favorable. That's more than the benchmark of 64.6. So we have then a theoretical premium selling edge of 4.6%. Statistically, then, it's more likely than usual that this current market condition will end up being a favorable one for selling premium, using condors and butterflies. Okay, so that's the condor and butterfly timing report. Let's go to the bull put spread timing report. This is for those that like to sell premium, option premium in the puts out of the money, a standard deviation away, roughly 30 days out. That's the presupposition going into this. So of those 4,588 daily closes of the S&Ps, roughly 82.7% of those have been favorable bars for selling that put premium down there, standard deviation away 30 days out, where the actual 21 bar downside movement, that's 30 calendar days, 21 bars, okay, that downside movement, the actual was less than what was being implied by the option prices. And we look again at the skew adjusted VIX and what it's implying for that downside move. Okay, so that's 82.7%. That's the benchmark. Now, of our 162 times that our market condition has occurred, 87.6% of the time the market did not move down and strike that level. Or no, it did not move down and hit that. So then roughly, 12 4% of the time, it did move down and hit that level. So we have an edge here. Okay, we have an edge of roughly 4.9% for selling this put premium, a standard deviation out of the money 30 days out. Okay, so that's it for the bull put spread timing report. Now, look at this. This is a brand new format for the market likelihood report. Brand new format. Let's take some time here. Let's look at the benchmark. Of course, we come up here. Let's just take a look. Oh, and I didn't change these out here. Okay, 1 second. Okay, we switched this out. Very good. So this is the new market likelihood report. Take a look at the top. Since Jan of 2000, let's just go to that line right up here. We've had 4,591 occurrences. And let's start on the left. What we're looking at here is the rate of change. The 5-day rate of change, the 10-day rate of change, and the 15-day rate of change. So if you look at all 4,591 occurrences of the S&P 500's close since Jan of 2000, on average, okay, from close to a close 5 days in the future, you have roughly a 0.1% change on average over the course of 5 days. The 10-day rate of change from one close to the close 10 bars later is roughly 0.19 or 1/5%. Remember, the market's been very bullish in the course of all those years. Now then, on the 15-day rate of change, you have 0.28. Okay? So that is the rate of change on average. Okay? You could flip a coin, and on average, you're going to land on a bar where over the course of the next 5 days, on average, it would change roughly 0.1% in 5 days. Okay, now let's look at what happened with our current market condition that occurred 162 times. All right, and that's roughly 3.5% of that population going back to Jan of 2000. The 5-day rate of change is 0.19, that's almost twice as much on the upside as you have for the benchmark. Then take a look at the 10-day rate of change, 0.38. Okay, twice as much as that. Again, twice as much as the benchmark. And then on the 3-week change, you have 0.62, much greater than 0.28. Now, how big of a deal are those? Is that a big deal that these are roughly twice as much to the upside as the benchmark? Okay, well, to answer that, we look at something called z-scores. And z-scores, and what they measure is basically the percentage of a standard deviation that these differences are. See these differences down here? Okay, oh, and I kind of messed that one up. So we look up here to the top, and we see that the 5-day standard deviation is 0.81%. The 10-day standard deviation is 1.15, and the 15-day standard deviation is 1.39. Because these differences in rates of change, we don't know if they're a big deal or not. And the only way to determine if they're a big deal is to look at how much of a percentage of a standard deviation they are. If these differences reflect a full 1 or 2 standard deviations to the upside, well, that's a big deal. Okay, if they're within half a standard deviation, not a big deal, and that's what we got here. Okay, these levels of a difference to the upside is 0.11 of a standard deviation. Okay, that's not that much. And let me get rid of that. I just noticed here. Let me erase this. There we go. Yeah, we erased it. Good. Okay. All right. So just look at this. The 0.09 of a difference on the upside. Okay, if a standard deviation is 0.81, okay, that's just a 0.11. That's just a little more than 10% of a standard deviation difference to the upside. That's not a big deal, and neither are these z-scores. So yeah, there's a bias to the upside, but the difference is just not that much relatively. Okay, and so what then we do also is look at what happens if on Monday the market goes up above Friday's high. Well, now we have a bit of a different, a different story. Now you have some big upside numbers here, and the differences are much greater than what you'll see on the 5-day. But we come over here to the z-scores, and now we're talking a little more than half a standard deviation of the upside, just under a standard deviation of the upside on the other two. So nothing to write home about, but certainly greater than the benchmark in total. Now, what happens if on Monday the price goes below Friday's low? Wow, look at this. Now you have a 5-day change of minus 0.58%, minus 0.3%, and minus 0.08%. Here are the differences, and then here are the z-scores. And these are to the downside. This is 0.83 of a standard deviation to the downside, 83% of a standard deviation to the downside, basically. Okay, and that's the most significant z-score we have going into Monday, is if the market goes below Friday's low, okay, you have on average, the average rate of change is definitely bearish at that point, and the z-scores, at least for the 5-day level, are pushing a standard deviation of the downside. That's pretty significant. Now let's go to volatility. Okay, we're looking at the realized volatility. On average, over the course of several years, going back to Jan of 2000, the market experiences a volatility of roughly 15.5 to 16%. That's the realized volatility. That's what's going on in the S&P 500. Now, in our current market condition, when you go back and look at the 162 occurrences, the 5, 10, and 15-day volatility levels are all in between 13 and 14%, much lower. Okay, and if the market goes above Monday's high or Friday's high, now we're in the 12s and 13s. If it goes below Friday's low, then those 63 occurrences on average had a realized volatility in the 14s, pushing 15. Down here we show what the short-term VIX is, and then the 9-day VIX, and then the 30-day VIX, both in the 20s, with the short-term VIX, 9-day VIX being at 20.34 and higher than the 30-day VIX of 20.21. Okay, so noting that the VIX is higher than what the predicted volatilities are given our current market condition. Very interesting. And again, it leaves, lends credence to the notion of us having an edge for premium selling, either from the bull put spread or from the Condor butterfly perspective. Okay, I hope you like this new format for the market likelihood report. I think it conveys more information in a single grid like this. Thanks for watching. I'm Steve Lentz with Discover Options. Have a great week of trading. Bye-bye.